Hey everyone, welcome back to Corporate Decoder, the place where we spill the tea on corporate filings. And let me tell you, Accession IoT Group Ltd's latest report is serving up a dish of well. Let's just say it is a mix of serious growth and some significant challenges. This report from ARB IoT Group Ltd. It is an annual report and it is like looking at a company trying to level up. They're talking big game about IoT, smart technology, and expanding across Southeast Asia. But as always, we need to peel back the layers, so stick around as we decode what really matters in this filing. And hey, if you love getting the real scoop on company finances without the corporate jargon, hit that subscribe button. We also have a fantastic community building over on our Discord server, link in the description below, so come join the conversation. First off, let's talk about where the money is coming from. Imagine a small business that relies on just a few big clients. That is kind of what we're seeing here. For them, 3 major customers were responsible for nearly 70% of all their revenue in the past year now. For a growing company, having a few key clients is normal, but that is a huge chunk. If even one of those big clients decides to spend less or even worse, walks away, it could seriously hurt their income. It is like having all your eggs in a very few, very large baskets. Speaking of customers, they buy a lot of their products on credit. That means ARB IoT Group plays the role of a bank, essentially lending money to their customers. And you know what comes with lending money, right? Credit risk. They admit right here that if too many customers don't pay them back, it could really mess with their money situation, their profits, and how much cash they have to run the business. It is smart to offer credit to make sales, but it's a balancing act. Now, here is a crucial detail about how they're set up. IoT Group is what we call a holding company. Think of it as a parent company that owns other companies, its children. It does not really do much business itself. All the actual work, all the actual making and selling of things happens in those subsidiary companies. So if the parent company needs money to pay its bills, to pay off any loans, or to give any money back to its investors, it has to wait for its subsidiary companies to send that money up to the top. It's like waiting for your allowance from your parents to buy something you want. When it comes to delivering their technology projects, they have deadlines and specific goals to meet. If they miss these dates or fail to hit those goals, they state clearly here that they could face penalties or have to pay damages. This is common in project-based work, but it means they're under pressure to perform perfectly and on time, or it could hit their finances and their reputation. This next one is a bit of a head-scratcher given their business, but they are flagging it. They say a major safety incident could be costly. Now, for a tech company dealing with IoT and software, a major safety incident isn't the first thing that comes to mind. However, when you consider they provide solutions for construction and agriculture, where safety is a huge deal, they're basically admitting that if something goes wrong on a job site or with their equipment, it could lead to big legal bills and really damage their image. This is where things get exciting but also risky. They are heavily investing in artificial intelligence, partnering up, expanding into new regions, and have landed some big orders for servers. But they're very upfront here. They say these big new ventures might not work out as planned. They could face problems getting things made, dealing with suppliers and even managing cash flow. It's the gamble on the future. But they openly admit the dice might not roll in their favor. Even their newer, more innovative products like smart farming systems using AI, robots, and drones come with a list of potential issues. They might not actually boost farm yields as much as hoped. There are always safety concerns with robots and drones, not to mention rules and regulations they have to follow. And if one of their drone systems causes damage, they could be on the hook for product liability. It's good they're innovating, but these innovations aren't without their own unique set of headaches. In the fast-paced tech world, staying current is everything. They acknowledge here that if they don't keep up with new technologies and what customers want, their entire business could suffer. This means they have to constantly be on the ball investing in new tech just to keep up, which is a never-ending race. No surprises here, but they officially state it. The market they are in is very competitive. They're up against big software companies, other IoT players, and even electronics brands creating their own tech. This means they have to fight hard for every customer with smart pricing, great service, and innovative products. Competition is fierce, and they know it. Since they operate in Malaysia, but their shares are traded in US dollars, currency changes are a big deal for them. If the Malaysian ringgit gets stronger compared to the US dollar, the money they make in Malaysia might not be worth as much when they convert it back to dollars. And the opposite is true too. This kind of currency fluctuation can really impact their financial statements and the value of your investment. This is a standard warning you see in many filings, but it is important. The price of their stock, their ordinary shares, can bounce around a lot. It might go up or down for reasons that have nothing to do with how well the company is actually doing. Things like general market news, investor sentiment, or even just rumors can cause big swings. They are telling investors directly that the stock price could drop and you could lose your money. If you are looking for a company that pays you a regular income through dividends, Arkansas BIT Group is not it. They explicitly state they have never paid cash dividends and they do not plan to anytime soon. All the profits they make, if they make profits, will be reinvested back into the business. So, investors looking for passive income need to look elsewhere. You're betting on the stock price going up, not on receiving regular payouts. Let's dive into the actual numbers now. We are looking at the consolidated statements of operations for the fiscal year ending the 30th of June 2025. Their revenue really jumped. They reported RM 197.3 million, which is about $46.8 million. That is a massive increase of 239% compared to the year before. When they brought in RM 58.2 million, this surge is mainly thanks to sales in their IoT Smart Building and Engineering and IoT Smart Agriculture divisions. It looks like their strategy of selling things like AI Wi-Fi optimization and IoT vending machines is paying off handsomely. But you often see that when revenue goes up, so does the cost of making that revenue happen. And that is exactly what ARB IoT Group is showing us. Their cost of sales for the year ending the 30th of June. 2025 shot up to RM 205.5 million, which is about $48.7 million. That is an increase of over 161%. So, while they sold a lot more, it also cost them a lot more to get those sales done. This jump in costs is closely tied to that massive revenue increase, which is a good sign in that their business is growing, but it is important they manage these costs effectively. Now, when you look at the difference between their revenue and their cost of sales, which is gross profit, things get a bit mixed. For the year ending the 30th of June 2025, they actually reported a gross loss of RM 8.1 million, or about $1.9 million. This is a big flip from the previous year when they had a gross loss of RM 20.3 million. So, while they are losing less on the gross level year over year, it is still a loss. This means the money they are making from selling their products and services is not covering the direct costs of producing or acquiring those products and services. It shows that they are still in a phase of high investment and growth, where they are prioritizing market share and expansion potentially over immediate gross profitability. And the expenses don't stop at the cost of sales. Their total expenses for the year ending the 30th of June 2025 climbed to RM 65.1 million, or around $15.4 million. That is a nearly 39% increase from the previous year. They highlight that this increase is largely due to higher depreciation of their equipment and amortization of their intangible assets, meaning the cost of using and writing off their longer-term investments is going up significantly. But the most striking figure in their expenses for this past year are these impairment losses. They've recorded RM 26.7 million, about $6.3 million, in impairment losses for the year ending the 30th of June 2025. This is a huge number that was zero in the previous year. Impairment losses mean they've had to acknowledge that some of their assets, like goodwill and other intangible assets or property, plant, and equipment, are worth a lot less than they thought. Essentially, they've had to write down the value of their investments because they are not performing as expected or have lost their value. This is a serious red flag, indicating that some past investments or acquisitions are not panning out like they hoped. When you put all of this together, the picture for the past year ending the 30th of June 2025 is a net loss of RM 71.4 million, or nearly $17 million. This is a worsening of their loss compared to the previous year, when they had a loss of RM 54.7 million. The company is growing its revenue significantly, but these heavy expenses, especially those unexpected impairment losses, are really weighing down their bottom line. Let's quickly check their balance sheet. As of the 30th of June 2025, their total assets stand at RM 206.4 million, which is about $48.9 million. A big chunk of this is in their property, plant, and equipment and intangible assets like goodwill. Now, looking at those impairment losses we just talked about, it is likely that the value of those intangible assets, especially goodwill, has been significantly reduced in their books. On the other side of the balance sheet, their total liabilities are RM 16.2 million, or roughly $3.8 million. This seems relatively low compared to their assets, which is generally a good sign. However, it is about double their liabilities from the previous year, showing some growth in their financial obligations. And finally, their equity, which represents the owner's stake in the company, is RM 190.2 million, or about $45.1 million. This is down from the previous year, reflecting those significant losses they've incurred. A key number to watch is often accounts receivable. For the 30th of June 2025, they report RM 41.8 million, which is about $9.9 million in trade receivables. This is up from about RM 27.8 million the year before. This ties back to their revenue growth and their credit terms. It means they've sold more goods and services but are waiting to get paid for them. As we saw in the risk factors, collecting this money is critical. They also have a line item for non-controlling interest. This represents the portion of ownership in some of their subsidiaries that belongs to other parties, not the main ARB IOT group. The amount is very small, RM 400, showing that they either consolidated all subsidiaries or that other ownership states are minimal. Overall, Arkansas BIT Group is a company in a rapid growth phase, expanding its revenue dramatically. Their foray into AI, smart agriculture, and server orders shows ambition. However, the significant impairment losses are a major red flag, suggesting that some of their past decisions or investments have not paid off, leading to a write-down of an asset's value. This, coupled with the increased expenses and a worsening net loss year-over-year, paints a picture of a company prioritizing aggressive expansion, potentially at the cost of immediate profitability and financial stability. They are heavily reliant on a few key customers and have significant credit risk. The direction is growth, but it's a high-stakes gamble, and investors should be aware that the road ahead, as they themselves admit, is fraught with execution, supply chain, and financial execution risks. So, what is my take? ARB IoT Group is in a high-growth, high-risk phase. The revenue surge is impressive, but the impairment losses are concerning and point to potential missteps in past investments. They need to prove they can manage their costs, collect their receivables, and make these new AI ventures profitable. If they can navigate these challenges, the sky's the limit, but if not, the risks they themselves have outlined could very well catch up to them. What do you think about RBOT Group's performance and future prospects? Let me know in the comments below. If you found this deep dive valuable, please give this video a thumbs up. It really helps the channel, and subscribe so you don't miss our next corporate decode. And don't forget to join our Discord community. Linked in the description for even more insights and discussions. Thanks for watching, and I'll see you in the next one.